Have you ever thought about investing in the stock market but felt like you didn't know enough or didn't have enough experience? Well, in the book One Up on Wall Street by Peter Lynch, a super successful investor, he says that you actually have all the tools you need to be a great investor. In fact, he thinks you might have an even better chance than the professionals and big companies out there. So if you've ever wanted to try your hand at investing, One Up on Wall Street is a book you should definitely check out. Lynch will teach you how to be independent, do your homework, and make smart choices with your money. This is the takeaway summary of One Up on Wall Street, written by Peter Lynch. And welcome to Cash Crush, the channel that simplifies finance without giving you a headache. We've got entertaining and informative videos on personal finance, investing, business, and economics. So sit back and relax. Get ready to crush your financial goals with us here at Cash Crush. Reasons to invest on your own. You have what it takes to be successful in the stock market. You don't need to rely on professional investors or companies to help you. Professional investors also make mistakes, showing that they're not always correct. They often wait too long to purchase stocks, causing them to miss out on excellent opportunities. Their concern for reputation leads them to play it safe and avoid taking significant risks. Additionally, restrictions imposed by rules may prevent them from selecting companies that could be advantageous for you. Believe it or not, you have lots of knowledge that can help you make good investment choices. You use products and services every day. Sometimes you might even know more than the professionals. You can make your own decisions quickly and find hidden gems before big investors. So, don't underestimate your own knowledge and independence. You have what it takes to be a successful investor. Understand 5 truths before you invest. Even though you're equal to or better than any professional investor, you must be aware of certain key truths to have success and feel in control on the stock market. Truth number 1, investing involves risks. That means when you invest your money, there's a chance you might not always make a lot of money. In fact, some years you might even lose money. But don't worry, because if you're aware of this risk and prepared for it, you can handle it better. Here's the secret. If you learn to be patient and stay strong when the stock market goes up and down, you increase your chances of making a good return on your investment. Instead of panicking and selling your stocks as soon as you see them going down, you can stay calm and stick with them. Over time, they might go up again and make you some money. To make things even safer, you can educate yourself about the stock market and learn some good investment skills. You can read books, check out the financial section of the newspaper, or even talk to people who are already smart investors. When you know more about how things work, you can make smarter choices. Truth number 2. The goal of investing is to find a special kind of stock called a 10-bagger. What's that? It's a stock that gives you back 10 times the money you invested. Can you imagine how amazing that would be? When you find a 10-bagger, it can make a big difference in your overall return on investment. Guess what? You can find these kinds of companies all around you right in your daily life. Every year you might come across 2 or 3 companies that have the potential to become 10-fold increasers. Truth number 3. You should only invest money that you won't miss or need for your everyday life. Why? Well, you see, when you invest in stocks, there's a chance that you might lose some of that money in the short term. And if you invested money that you actually need for your daily needs, it can cause a lot of stress and problems. Here's the deal. The stock market can be unpredictable in the short term. That means it's hard to know for sure how stocks will perform right away. But here's the good news. Over a longer period of time, like 10 to 20 years, you can usually make a prediction about how stocks will do. So, it's important to be smart and careful with your money. Only invest the extra money that you won't miss or need for important things like food, clothes, and other essential stuff. This way, if there are temporary losses in the stock market, it won't negatively affect your day-to-day life. Truth number 4. When you find a company you like, focus on that company and not what the market is doing. First, the market is always changing. It goes up and down like a roller coaster. But here's the secret. It will eventually go back up again. So don't worry too much about what the market is doing right now. Second, there are lots of people out there who claim to know exactly how the market will perform. But guess what? They're often wrong. It's really hard to predict what the market will do in the future. Instead, focus on the company you're interested in. Do your research and see if it's a strong and promising company. If you think it has a bright future, then go ahead and buy its stocks. If the company is strong and well managed, it will likely do well in the long term, no matter what the market is doing at the moment. So don't let the market distract you. Truth number 5. There are different types of stocks, and it's important to know which type of company belongs to before you invest. Let me break it down for you. Slow growth companies. These are companies that don't grow very fast. They might not be the best choice if you want to make money quickly. Dependable companies. These are large and established companies that grow at a steady pace. They're a bit faster than slow growth companies, and they can help keep your portfolio stable when the market goes down. Fast growth companies. These companies are small and growing really quickly, like 20 to 25 per year. They have a lot of potential to become super successful and make you a lot of money. But remember, they also come with more risk. Cycle companies. These companies go through cycles of growth and contraction. It's important to understand when it's the best time to invest in them so you don't get caught in a downswing. Remember, what goes down usually comes back up. Underdog companies. These are companies that might be going through a slow phase, but they're expected to bounce back and grow rapidly in the future. Investing in them when their stocks are low can be a smart move. Hidden treasure companies. These companies have something special that others might not know about. It could be cash, real estate, or some other advantage. It takes insider knowledge to recognize this hidden advantage. Here's something cool. Companies can change their stock types over time. Fast growth companies can slow down or become cycle companies. Slow growth companies can become underdogs or even hidden treasure companies if someone discovers their hidden advantage. So it's important to understand the type of company you're investing in. Each type comes with its own opportunities and risks. Truth number 6. Stay in the stock market for the long term. Once you invest, keep your money there and don't panic. The market can go up and down, but if you have a long-term plan, you can ride it out. Don't make hasty decisions based on short-term changes. Trust that your investments can grow over time. Stick to your plan and enjoy the journey of investing. How and where to find great investment opportunities. According to Lynch, the best places to look for these opportunities are in your daily life and work. Familiar companies that you interact with regularly are great candidates for investment. However, Lynch advises against investing in companies that you don't understand or trendy companies that everyone else is investing in. It's also best to avoid companies that are diversifying too much or relying heavily on a single buyer. These types of companies are more likely to face challenges or fail in the long run. When you're searching for good investment opportunities, pay attention to companies with positive attributes, such as mundane or unappealing companies. Sometimes, companies with less exciting names or in unglamorous industries can actually perform really well. Companies that have branched off from larger companies. When a subsidiary becomes its own independent company, it often starts off on a solid financial footing because the parent company sets it up for success. Companies in no-growth industries. Industries that don't appear to be growing may have less competition, allowing strong companies to thrive. Remember to do your research and consider companies that align with these positive attributes. How to research a company before investing. When you find a company you're interested in, Lynch suggests doing some research before investing. It doesn't have to take too long, just a few hours per stock. Here are the steps to follow. Step 1. Identify the type of stock. This helps you decide if it aligns with your needs and risk tolerance. For example, if you want lower risk, you might consider investing in a dependable company. Step 2. Collect relevant data. Based on the stock type, gather the necessary information to evaluate the company's future potential. Remember, taking the time to research can help you make informed investment decisions. Here's the data you should find. P/E ratio. The P/E ratio stands for price to earnings ratio. It helps you determine how the stock price relates to the company's earnings. To find the P/I ratio, divide the stock price by the earnings per share. P/E ratio tells you how many years it would take for the company to earn back your initial investment. A high P/E ratio may not be attractive, while a low one may be more appealing. You can also compare the P/E ratio to other companies in the same industry or to the company's previous ratios. This helps you determine if a stock is priced fairly, too high, or too low. Assets and liabilities. Assets are what the company owns. It's a good sign if a company's assets are growing over time, while liabilities are the company's debts. It's ideal if the company's liabilities are shrinking over time. By comparing assets and liabilities, you can get a general sense of the company's financial standing. Dividends. Dividends are like regular payments a company gives to its shareholders. Some companies choose to share their profits with their shareholders by giving them money on a regular basis. Not all stocks pay dividends, so if you like getting a regular payout, you may prefer stocks that do pay dividends. On the other hand, some companies choose not to pay dividends to their shareholders. Instead, they invest that money back into the company to help it grow. This can potentially lead to greater profits when you sell the stock later at a higher price. Lynch himself prefers to invest in fast-growing companies that don't pay dividends rather than slower-growing companies that do. Understanding the company's additional factors. In addition, there are more things to consider when researching a company, such as, does the company have special assets? Has the company recently diversified? Is the company buying back its own shares? Does the company have a large inventory? Remember, these additional factors help you gain a deeper understanding of the company and its potential for success. Step 3. Explain why the company is worth investing in. Create a short speech explaining why the company is worth investing in. You can practice this speech by talking to yourself or sharing it with someone else. This exercise helps solidify your reasons for buying the stock and allows you to question those reasons if they don't seem strong enough. Remember, it's important to periodically review the reasons why you invested in a company, even after you have made the investment. By following these steps and staying informed about your investments, you can make informed decisions and adapt your investment strategy accordingly. Tips for managing a stock portfolio in the long run. Now that you have bought your first stock, it's time to learn how to manage your stock portfolio in the long term. Let's see what Lynch suggests for managing your portfolio throughout your life. Buy stocks in companies you understand. According to Lynch, it's a good idea to invest in stocks of companies that you have special knowledge about or have thoroughly researched and trust. If you're wondering how many stocks to buy, Lynch recommends having between 3 and 10 stocks. Owning multiple stocks is beneficial because it increases your chances of finding a stock that can grow 10 times in value. Additionally, when you own multiple stocks, you have the flexibility to allocate your money between them. Build your portfolio based on your risk tolerance. When building your portfolio, it's important to consider the level of risk and potential gain associated with each type of stock. You want to acquire stocks that offer a risk versus gain ratio that matches your comfort level. Regularly assess your stocks and make wise decisions about moving your money between them. It's important to regularly reassess your stocks and make smart decisions about moving your money between them, advises Lynch. Aim to maintain a balanced distribution of stock types in your portfolio. For example, you might want to have 3 dependable, 2 fast growth, and 1 slow growth company. Know the right times to buy and sell. According to Lynch, you should buy stocks when you believe the company is strong and you are paying a fair price for the stock. There are also specific times when stocks are available at a bargain. When it comes to selling stocks, try to avoid selling too soon. Lynch shares instances when he regretted selling stocks too early as they continued to grow in value. Make your own decisions on how to handle your portfolio. Rely on your own research and ongoing monitoring of the company's performance to guide your selling decisions. Avoid following general beliefs or sayings about when to buy or sell stocks. There is no one-size-fits-all rule that works in every situation. All right, guys, that's a wrap. Thanks for watching, and don't forget to hit that subscribe button so you never miss out on our latest videos. Goodbye.